When Bitcoin pulls back, people tend to forget almost everything they learned during the previous cycle. The emotional part of the brain takes over, and suddenly every drawdown feels like the beginning of the end. It doesn't matter how many times this pattern has played out. When fear hits, logic tends to disappear. But if you look closely at how markets behave, especially Bitcoin, you'll see that the same psychological traps appear during every single correction. The strongest of those traps is loss aversion. Humans feel the pain of a loss far more intensely than the pleasure of a gain. It's not rational. It's neurological. A 20% drawdown feels worse than a 20% rally feels good. This makes investors overreact to downside volatility even when nothing fundamental has changed. Bitcoin's price may swing violently in both directions, but emotionally, only one side of the movement sticks. Then comes recency bias. Investors assume whatever is happening right now will continue happening indefinitely. If price is falling, they project that forward. If sentiment is bleak, they assume it will stay that way. Recency bias makes people see short-term turbulence as long-term doom. But if you zoom out, these dips look almost identical across cycles. Fear clusters at the same moments, even when the long-term trend remains intact. What's interesting is how on-chain data captures the difference between what people feel and what they actually do. During most drawdowns, you'll see headlines about panic selling. You'll see social media flooded with bearish takes. But when you examine the blockchain, long-term holders are usually doing the opposite. Their supply increases, exchange balances decline, holders with conviction continue accumulating quietly, even as sentiment collapses publicly. This happens because emotions operate on a far shorter time frame than conviction does. Panic is immediate. Confidence builds slowly. But Bitcoin has always rewarded the side of the cycle where logic returns. Every major correction, whether in 2013, 2017, 2021, or 2025, they all came with a wave of fear that convinced people the cycle was over. The data eventually showed the same thing each time. Long-term holders used those moments as opportunities. That's why fear itself tends to be a lagging indicator. By the time most people finally feel terrified, the worst of the correction has usually already passed. Markets are forward-looking, emotions are backward-looking, and Bitcoin exposes that gap more clearly than almost any other asset because of how quickly it reprices. The challenge isn't identifying bottoms, it's recognizing when your emotions are signaling the past instead of the future. Fear feels real, but it isn't predictive. It's reactive. And if you rely on reactive signals, you will almost always move against your own best interest. Bitcoin pulls back sharply because it's a fixed supply asset adapting to a changing world. Investors panic sharply because they're wired to overreact to loss. Those two forces collide during every correction, and each time the people who step back, who zoom out, and separate signal from emotion tend to make the clearest decisions. If you want help understanding these market behaviors without getting pulled into fear-driven responses, you can explore more at learningcrypto.com. It's where we break down these psychological patterns, the data behind them, and the tools that you can use to navigate this space with clarity instead of instinct.